Welcome Chaos Theory enthusiasts. I'm Rahul, your guide through the tempestuous seas of financial chaos. In this captivating season 2 of the Chaos Theory, where chaos is our guiding force, today marks episode 24 of our 50 Days of Chaos series, a daily exploration into the unpredictable twists of the financial realm. Before we dive into the nuances of financial chaos, let's acquaint ourselves with its primary protagonist, market volatility. Picture it as the heartbeat of financial markets, pulsating with the rhythm of uncertainty. In this segment, we'll delve into the definition of volatility and its profound role in shaping the narratives of financial world. Now, what sparked these market tempests? Economic indicators, global events, and speculative whispers all contribute to the symphony of chaos. Join me as we unravel the triggers that set the financial stage ablaze with volatility, exploring the multifaceted forces that drive markets to dance on the unpredictable tunes of chaos. Shifting our focus to the actors in this financial theatre, you, the investors. How do you navigate the storm when uncertainty becomes the only constant? In this segment, we'll embark on an exploration of the psychology of investors during high voltage market movements, unveiling the delicate dance between fear and opportunity. Chaos isn't merely a disruptor, it's also a creator of opportunities. Volatility, in the context of trading, essentially measures how much prices of financial assets like stocks, bonds, or cryptocurrencies fluctuate over time. Imagine you're on a roller coaster. High volatility is like those intense twists and turns that make your stomach drop. Prices shoot up and down dramatically. On the other hand, low volatility is more like a calm boat ride on a still lake. Prices stay relatively stable with minimum ups and downs. Traders keep a close eye on volatility because it affects the risk and potential rewards for their investments. High volatility means higher risk, but also the higher chance of bigger profits, while low volatility implies less risk but potentially smaller gains. Understanding volatility helps investors navigate the tumultuous seas of financial market. Market volatility is like the heartbeat of financial world, and understanding its causes is crucial for any investor. One major driver is economic indicators. When reports on things like unemployment rates or GDP growth are released, they can send shockwaves throughout the markets as investors reassess their positions based on new information. Then there are global events, from geopolitical tensions to natural disasters, which can shake market sentiment and send prices on a rollercoaster ride. Company-specific events also play a pivotal role. Anything from earnings report to legal troubles can cause fluctuations in individual stocks. And let's not forget the good old speculation. When traders engage in risky bets or follow trends, they can amplify volatility, adding more excitement and risk to the market. So, whether you are a seasoned investor or just starting out anew, keeping an eye on these factors is key to navigating the wildfires of finance. Volatility, the wide swings in market prices, is like the heartbeat of the financial world. To measure it, statisticians use tools like standard deviation, which essentially tells us how much prices deviate from their average. One popular measure is the VIX, or the Volatility Index, which tracks the expected volatility of the S&P 500 index. This index gave us the sense of how turbulent the markets are expected to be in the near future. So, when you hear people talking about volatility, they're essentially referring to the uncertainty and unpredictability in market movements, which can either excite or terrify investors. Now, let's talk about the impacts of this volatility. High volatility isn't just a roller coaster ride, it's a double-edged sword. On one hand, it can represent opportunities for savvy investors to make big profits by capitalizing on price swings. But on the flip side, it also heightens the risk of insignificant losses, particularly for those who aren't prepared for the ups and downs. Moreover, During periods of extreme volatility, investors tend to become more risk averse, seeking safe havens for their money. This flight to safety can further exacerbate market swings and affect asset prices across the board. So, while volatility can be thrilling, it's also something that demands caution and strategic thinking in the world of finance. When it comes to navigating the complexities of financial world, risk management is paramount. To effectively manage risk, one must first identify the various types it can take. Market risk encompasses the fluctuations in asset prices due to factors like economic conditions, interest rates, and geopolitical events. Credit risk arises from possibility of borrowers defaulting on loans or failing to meet their financial obligations. Operational risk stems from internal processes, systems, or human error that can lead to financial losses. And then there is systemic risk, which refers to risk of widespread financial instability due to interconnectedness within the financial system. One powerful strategy to mitigate risk is diversification. By spreading investments across different asset classes, industries, and geographical regions, investors can reduce the impact of a single adverse event on their portfolio. Diversification helps ensure that if one investment performs poorly, others may offset those losses, thereby stabilizing overall returns. Another tool in the risk management arsenal is the use of derivatives. Options, futures, and other derivatives can be employed to hedge against potential losses and manage risk exposure. For example, investors can use options contract to protect against downside risk in the stock holdings or employ futures contract to hedge against adverse movements in commodity prices. Derivatives offer flexibility and precision in managing risks, allowing investors to tailor their strategies to specific market conditions and investment opportunities. Stress testing is another critical aspect of risk management. By subjecting portfolios or financial institutions to simulated adverse scenarios, stress tests help evaluate the resilience and identify potential vulnerabilities. This proactive approach enables investors and financial institutions to assess their ability to withstand market shocks and adjust their risk management strategies accordingly. Robust modeling is essential for accurately assessing risk and making informed decisions. Sophisticated mathematical models and analytical techniques enable investors to quantify potential losses, understand the underlying risk factors, and gain insights into portfolio dynamics. By incorporating historical data, market trends, and macroeconomic variables, these models provide valuable guidance for risk management and portfolio optimization. Liquidity management is also a key to effective risk management. Ensuring sufficient liquidity to meet financial obligations is crucial, as illiquidity can exacerbate financial stress and increase the likelihood of losses. By maintaining adequate cash reserves and managing cash flows efficiently, investors and financial institutions can mitigate liquidity risk and navigate turbulent market conditions with confidence. Finally, continuous monitoring is essential for staying ahead of evolving risks and market dynamics. Regularly monitoring financial markets, economic indicators, and internal risk metrics enables investors and financial institutions to identify emerging risks, adapt their risk management strategies, and seize opportunities as they arise. By remaining vigilant and responsive to changing market conditions, investors can effectively manage risk and achieve long-term financial goals. In summary, effective risk management requires a comprehensive approach that encompasses risk identification, diversification, and the use of derivatives, stress testing, robust modeling, liquidity management, and continuous monitoring. By employing these strategies in tandem, investors and financial institutions can navigate uncertainty, protect against potential losses, and position themselves for long-term success in dynamic world of finance. Regulatory measures are like the guardrails of financial highways, designed to keep the system stable and protect investors. One such measure is market circuit breakers, which act as emergency brakes during extreme market volatility. Implemented by exchanges, these circuit breakers temporarily halt trading to give investors time to catch their breaths and prevent panic driven sell offs. It's like a timeout in fast paced games, allowing everyone to reassess and regroup before diving back in. Capital adequacy requirements are another crucial regulatory tool. Regulators impose these requirements on financial institutions to ensure they have enough capital on hand to weather potential losses. Think of it as a financial safety net. By mandating the banks and other institutions maintaining adequate reserves, regulators help shield depositors and investors from the fallout of financial downturn. Lastly, transparency and disclosure requirements play a pivotal role, fostering trust and confidence in financial systems. Enhanced reporting standards and disclosure rules compel companies to provide investors with more comprehensive information about their operations, financial health, and potential risks. This transparency empowers investors to make informed decisions, reducing uncertainty and promoting market efficiency. So, while regulations may seem like red tape, they essentially safeguard that underpin the stability and integrity of financial markets. As we wrap up this episode, let's recap the journey through market volatility and risk management. From defining chaos to exploring the tools to tame it, we have covered a spectrum of insights. Remember, this is just one chapter in our 50 Days of Chaos saga, and there's much more chaos to uncover in the days ahead. Thank you for joining me in the Chaos Theory. Your questions, thoughts, and chaotic tales are always welcome. Stay tuned for more chaos in upcoming episodes. Until then, embrace the uncertainty, and I'll catch you in the next installment of Chaos Theory, where the chaos continues to unfold. As we forge ahead in the 50 Days of Chaos, anticipate more intriguing explorations in the realm of unpredictability. Get ready for exciting topics that will unravel the complexities of chaos even further. Until next time, chaos enthusiasts, keep the chaos alive. This is Rahul, signing off.